All right, so we're looking at the SPY this evening. This is the S&P 500 index. You can do these strategies on anything. I'm just using this as a generic um, ABC XYZ type of company tonight. Right? So the way we're going to do it is, first of all, we're going to talk about just a quick understanding that kind of show the difference of being the seller and then the buyer. All right, so we're not going to pick any criteria that we normally do. We're just going to show something here. All right, so I'm going down here and I'm selling this. I'm selling this 5 point wide put spread. And if you sell a put spread, you are bullish. If you sell anything that's a put, if you sell a naked put or you put spread or sell a put condor or something such as that, a put butterfly, you are bullish. Okay? You're always bullish when you're selling a put. And if you sell a spread, like a vertical spread like this, the most you can lose is between the strikes. If you're trading options on stock, if you're trading options on futures, you just have to know the denominator. When you're trading options on stock, the denominator is 100. So this is 5 points in between these two, this spread. Right? A spread is one leg. It's more than one leg. It can be two legs or more. That is a spread. In this case, we're looking at a traditional two-legged spread, the selling of the put spread. It's a 5 point wide spread. The most you can lose is 5 times 100. So the most you can lose on this is 500. And then you take in the premium that you have. So minus the premium, in this case, $37 minus the premium. So the most you can lose is this on the TastyWorks platform here is $463. That's the most you can lose on that. This obviously doesn't meet our criteria and so forth, but I want to show you the difference of selling a put spread to be bullish and then buying a call spread to be bullish, right? It's the same kind of concept. You're bullish. But it's some strategic differences. All right, so looking at this curve view, you want to make sure you understand that 5 point wide equals $500, right? And if you're the seller, 500 is what you can lose minus the premium you receive. All right, so let's jump over to this curve view. And the beauty of why we sell put spreads to be bullish is because we do not have to necessarily be right directionally to win. As you can see here, this is at the money line. If it goes up, we're going to win 100% of the time. Okay? If it goes down, as you can see through this green shaded area, we can still win. Right? As long as it doesn't go past this short strike here for the most part. Once it goes there, then we lose. This is the loss zone here, but we stop losing once it hits this built-in stop loss. A spread has a built-in gain limit and a stop limit. Okay. All right. So this is the put spread. What makes it significantly unique for us is that we do not have to be right directionally. We can be wrong and still be right. And to me, that's fascinating because most of the time we're only, at best, we're only right 50% of the time. Okay? We're only right 50% of the time. So I want to be right a lot higher than that, a lot more than that. So doing the put spread to be bullish allows me to do that because if I'm wrong, I can still be right. All right. So now let's kind of jump into being bullish. If we buy a call spread, and this is buying now, and let's keep it 5 points wide. Okay, let's keep it 5 points wide. This is 5 points wide, everyone, between these two spreads. It's still a spread. It's still a vertical spread. Okay, it's an up and down spread, and it's worth 500. So the most you can make is 5 times 100 is 500. So the difference is that when you're the seller, the most you can lose is 500. When you're the buyer, the most you can win is 500 on this 5 point wide spread. In this case, the most you can make is 500 minus what you pay. So you're paying $277 here for this call spread. So the most you can make is 223. So you take the 500, the most you can make minus what you paid. So now this is the most you can make is the $223, right? So, but that sounds attractive, right? Especially on this type of example we were just showing. We were at a 15 delta on the put side. The most you can make before fees and commissions on this example, obviously we wouldn't do that trade, is $37. but you had an 85% chance of winning on at expiration. We're basing all the probabilities tonight, everyone, on expiration, because that is what probabilities are based on. They're based on expiration. You can have better probabilities before expiration, but right now we're talking about the Black-Scholes type of calculation. What is it based on? It's based on expiration, that last day, that 44 days. So that's keep that in mind. All right, so the put spread we were looking at had an 85%. You got a question?
Where
Yes.
did the number 85% come from? Can you explain that?
Yes, it came from if we sold at a 15 delta. You see these deltas here? On the put side, we were over here on the put side, and we were
if you
selling.
sold at 15, okay.
Correct. We sold at the 15, so that means that's where the 85% came. Right now, I'm kind of going back to what we did so you can understand this part. So that was 85% chance of winning. This right here, everyone, we're buying at the 50 delta, but what is the probability of success? Is it 50? We for simplicity purposes, we normally say if you buy something at the 50 delta or sell something at the 50 delta, you have a 50% chance, or a 50-50 chance, a coin flipping chance of winning, right? Of making at least 1 cent. So that's the generic part, right? But if you want to get completely technical, then you have to factor in how much you are receiving to determine your loss, where you start losing at, or how much you're paying to determine how much you're buying at. So in this case, everyone, we are, that just make this easy math, and I just say we're buying at $3 here. Okay, we're buying at $3. It's a 5-point wide spread. This is a call spread. We're being bullish. It's a 5-point wide spread. It's time 100 once again. The most we can make is $500 minus the premium we receive. So in this case, we're saying we're paying $300. So the most we can make is $200 here, as you can see down here. But to determine your probability, even though we're buying at this 50 delta here, this call spread, to determine your probability, you have to, at expiration, once again, you have to factor in how much you are paying. So you're paying $3, so you have to go $3 from where your strike is from, right? So this is 1, 2, 3. So this is your break even right here at this 438. So what is the probabilities of 438? Hitting 438. Bam, right there. 43%, right? But if it hits the 43%, right, that's just break even. And you have to be a little bit past 438, or at least 1 cent past it, to be able to win, right? So TastyWorks is basically telling you this is a probability at expiration of 42%, right? So you have to keep that in mind. If you are the buyer, do not want to wait to expiration if you're the buyer, because you have to have the directional move has to go to what you believe it's going to be. In this case, we're saying bullish, so it has to go up, right? And then it has to go up not only a little bit, but it has to go up enough to outpace what you paid. And then it has to go up fast enough to outpace time decay, right? Because it's an expiration period. It's always an expiration period when you're dealing with options. So you can be directionally right, and a number of you bought options in the past, and most of us start off by buying options, and you realize, okay, man, I was right directionally, but I still lost on that trade because you were right, but it just didn't move enough, right? Or it didn't move fast enough, or it didn't move within the time frame that you needed to move. So it's all those different factors that are happening to you when you're the buyer. And so let me show you one of the things, why when you're the buyer, you need the move to happen for you, is that this is the at the money line, right? If it goes up, you win 100% of the time, but if it goes down, you lose 100% of the time as well, right? It's not like that being bullish with that put spread. That's why we love that put spread, because if you sell that put spread, you can be wrong directionally and still win. And obviously, you're going to, if the risk reward is set up a little differently. In this case, this is almost, buy one to make one here, which is not bad, right? If you're gonna buy something to make money, you want to do it at or in the money, okay? At the money or in the money, to give yourself some probabilities to win. because one of the misunderstandings about buying options is that most people don't realize your best probability is 50-50. You cannot have a probability greater than 50-50 if you are the buyer of an option, regardless if it's in the money. Even if it's deep in the money, you still cannot have more than 50-50. So let's break this down a little bit. Let's break this down a little bit more. All right, so if we move this spread here, let's just do this. If we move this spread into money, right? And so now this spread is going to cost a little bit more, right? It's going to cost a little bit more, and you can see we're buying at the 58 delta, and and we're selling at this 48 delta, right? So let's just say we need $3 again, so that's going to take us to around this 434 around here, right? So it's $3.29, so it's going to be a little bit higher than that. So this is basically telling us that we have a 48% chance of winning. It's probably a tiny bit better than that, but they're kind of rounding it. It's more like a 49%, and we can just say 50%. That's the best you can have, and you're doing this in the money, right? But the most you can make here, because you're paying $3.29, so the most you can make on this now is 171. Okay, the most you can make is 171. Your probability is a little higher than what we were just doing before. That was more like 42%. This is 49, maybe 50%, but you have a little less that you can make. But I just wanted to demonstrate how even if we go deep in the money, you still only got a 50% chance of winning. Right. So now it's important to understand, everyone, once again, that if you want to do a spread, you want to do it at the money or a little in the money so you can have the better odds. If we did this spread further out, everyone, if we did this I just say we did this at a 30 delta around this 30 delta here. Well, then we have all those things that we were talking about that you have to fight against when you're a buyer. But now you make it even tougher on yourself, because now you need it to go up even bigger and even faster for you to win, because it's you can see your loss zone is even more past the at the money line. And so you need it to go up in a big way before you can win. And as you can see, the probably it's going to cost you less, but your probability is going to be significantly lower, right? And think it's your TastyWorks here is showing those probabilities even a little wrong, right? So for example, this is a 29 delta. You have to go, but what you paid for it, so you're paying $1.37. So that's going to be somewhere in this area. So your probability of winning is, in this case, at expiration, is something like 25%. It's like 25% a chance of winning. That's not great odds. It's better than a lottery ticket, but it's damn near close to that, in my opinion. And you're going to continue to bleed money. So the best way to win when you're buying a call spread is, if you're being bullish, is to do the spread at or near at the money, and then get out before expiration. So if your probability is at expiration, as it says 43% here, you do have a high probability that it could touch this strike. And if it touches this strike within that time frame, because of time value, it's going to be more than most of the time, it's going to be more than this 277 that you purchase. As you get really closer to expiration, then it might not be, but almost 100% of the time it will if you touch that 440 strike. So in this case, if you paid 277 and then the probability of touching the 440 is 2 times delta, so that's a 38 delta. So 38 times 2, it's 76. So you have a 76% chance it's going to touch this 440. So what I would do is that if I bought this call spread, once it 100% of the time, if it hits this 440, I'm out of it. I'm taking my profits and running. But if I'm up $100, I would most likely take my profits and run on this because I paid 277. It's now trading for 777, so I can ring the register and win $100 because I paid 277. It's trading for 377. So you minus the 277, everyone, and then that means I make $100. I don't want to get out at expiration because that's going to make the probabilities what you see, and it's not going to be great for the buyer. But if you get out before, then you're going to have a higher probability. You can make your chances of winning, 60-70% consistently if you do it. So that's what I would do. So let's break this down and let's talk about buying a call, right? Let's talk about just buying a call outright. We're not really talking about the put side now. It's the same thing, everyone, if you just reverse it. But most of the time when people are buying something, you're being bullish on it. So I'm talking about the call so you can understand the process of buying. In this case, what you want to understand is that if you are, and let's just talk about the basics here again. If we are the buyer of this option here, right, it's at the 50 delta, and normally we say this is a 50% chance of winning at least 1 cent at expiration, right? So we just try to make it simple once again. But you have at expiration, you have to factor in how much you paid for the option, right? So let's just say down here you're paying $731, right? That's how much it's going for. The mid is $729, so we can even make that the mid down here. And so you have to factor in that 7. Right? You have to factor in that 7. So this is 5, this is 7. So your probability of you need it to be around here at expiration, right? So that's in between, the 34 and the 31 delta. And so TastyWorks is saying 36%. It's a little off, but I just say that's correct, right? That's still only a 36% chance that you're going to win at expiration if you buy this and hold to expiration. Right? That's not great odds. And in a normal market, in a market in 2020 after March, everything you bought, when you bought a call, whatever the case may be, it went up and you made money. As the calendar turned, you realize, okay, I'm not making money anymore. The market can still be going up like the NASDAQ, or your stock can still be going up. But if it's not going up fast enough, you're going to be losing because how much you paid, right? So for example, if you bought this SPY and it's actually here, it's trading right here, you could be losing because it's getting closer to expiration and you paid this amount. So it's not outpacing the amount you paid. Right? So this is the basics of options. You have to know how much you paid. One of the good things about buying to make money is that you have a defined risk, right? If you buy this here and you paid $729, that's the most you can lose. That's the most you can lose. And it can be a lot cheaper than buying stock, right? So for example, if we wanted to buy, let's just say, do this SPY and we wanted to, let's just say buy at the money right now with 44 days to go. Well, if we bought 100 shares of SPY right now, it's going to cost us over $43,000 to do it, okay? And if we bought it, we would need it to go up right away, right? We paid $43,000 for 100 shares. If it goes up, yeah, we win 100% of the time, but we lose 100% of the time if it goes down. And it's not going to go to zero, but this is the risk we have if it goes to zero. But it's zero chance it's going to go to zero. This is the index. But it could go down 20%, and that can really hurt, right? That can really hurt on this 100 shares that you bought. But you, instead of paying $43,000, you can buy the call and control the same amount of shares, 100 shares, for $729, right? And so the most you lose here is $729 to own those shares within the next 44 days. That's the worst case scenario can happen. If it's expired, worthless, that's how much you would lose. That's the worst case scenario. So that's attractive, and it allows you to control things for a fraction of the price. right? So things like Amazon, things that's really expensive, this is how you can benefit if you think it's going up. So you can also do what is called leaps, right? And I think Brandon kind of talked about that a little bit in Discord recently. And a leap is something that is long dated. It's stuff that Ernie does, but we usually are selling premium long dated. We call it long dated, but it's just the same kind of concept as a leap. So in this case, let's say we went out the 345 days, and if we bought the shares right now, and we said, okay, we think in the next year this SPY, this S&P 500 is going to be significantly up. That's still going to cost us $43,000, right? A little over $43,000 to buy 100 shares. We can also buy at the money here, and that's going to charge. I just put it here. That's going to cost us at worst, $2,800. Okay, so the most we can lose in the next year, basically, is $2,800. But if it goes up, we can make significant amount of money off the small amount that we use if we didn't buy these shares. Right? It can also be a stock replacement. And say you had 100 shares in SPY. It went up a lot, but you are feeling that it could go down 10, 20%. Where you can buy the call and you can lock in almost all your gains, but still have the control of 100 shares for a fraction of the cost. Okay, and you can also turn this into something that we call a poor man's covered call, right? So we bought this here for $2,800, as you guys can see. Then we can decide to turn it into a covered call. These are the shares. These act as the 100 shares that we have. So now we turn it into a covered call, and we can go back to this 44. This is called a diagonal as well, but a poor man's covered call. We can go back to this. Where does this 44 days to go? And then what we can do is say, okay, I think the SPY or the S&P 500 is going to continue to go up, but within the next 44 days, I don't think it's going to go above the 440. Or you can say even, and so you decide that you're going to, or you say it's going to go more, you don't think it's going to go 10 points more higher in the next 44 days. So you can sell this 444, which is basically a 30 delta. And then that'll lower your cost basis to 25. And then you keep selling, you keep selling calls against the call you bought over time, right? You got a year out, and you keep doing this every 30 to 45 days or so, and you keep selling these calls, lowering your cost basis. If it jumps up, you get all the appreciation. So for example, if it's trading at 434 and it jumps up within the next 44 days, you're going to make at least $10 on it, right? Because you got that appreciation from 434 to 444. You're going to make the $10 minus what you paid, but to that it's going to be $10 at least, because this back one, this one you bought for 345 days is going to be worth so much more, because it already has shot up, and you are now this is going to be $10 more in the money. So you will be able to make your $1,000 with that type of trade. Go ahead.
Well, I had a question, especially on the SPY, because I bought some for my kids back in March when it was really low, like around 200. And so now it's pretty high. And so I liked your idea. So you said, like, if you made a profit on it, you could use this as a way to make it, instead of owning all that capital. You don't own as much then?
So yeah, 100%. So let's just say you owned it at $200, everyone. Let's say she bought it was trading at $200 a share. And let's say she bought 100 shares, right? So you take your...
That's about...
that's like $20,000, right? And that's how much you paid. It's currently trading at double that, right? So you got the 434 times 100 shares, right? So it's currently trading at 43,000, to just say. So that's a profit of $23,000, right? And you can do this on an individual level. If you had 50 shares, if you had 25 shares, the same kind of concept for the most part, right? So, but to demonstrate this, if you had 100 shares, because that's a standard lot, or something close to 100 shares, but I just say 100 shares because that's the standard lot. then this makes a lot of sense, right? You made $23,000. Then if you go over here and just say you decided to do something like we just said, you think it's going to continue to go up. So you go all the way out to this 345 days, and even if you just bought this, right, that's going to cost you $2,800. So you take your 23,000 minus the 2,800, and you lock in $20,000 of your profit, but you still have all the potential of the upside with this call for the next year, right? Or you can do that, which is a fraction, or you can make it even cheaper, and then you can start doing the poor man's covered call or the diagonal, and sell calls against it. So in this case, let's say we did the same thing we were talking about. We're saying it's not going to go $10 higher within the next 44 days. It's going to expire above that. It's basically a 30% chance that's going to happen, right? So you play the odds, and you have a 70% chance it's not. So you sell this for this 444. That's going to drop your cost basis from 2,800 to 2,500, basically. So another $300 basically. And then you still locked in over $20,000 if that's the case, right? And to some of you, this might make sense. You've had something, maybe not in SPY, but you had something in something else like Riot or Disney or Microsoft or something.
Because I did Disney at like $83 when it dropped, or 86. So my Roth. So this one I would sell, or I would buy the year out at 175.
The year is just an example, right? You can go 562 days. You can decide, right? But right now the options they give us is 562 or 345. So if you go to the 345, it's basically a year out. And let's say you had 100 shares in your Disney. Well, and you bought it at 83. So you got a double already, right? So you can lock in your gains. And then if you think Disney is depressed a little and it's going to go up a lot more, or it's going to just go up in the next 345 days, then you can substitute it by buying a call at the money, right? And if you want to lower that cost of buying, because let's say the buying is this price here, it's not, it's 40 cents cheaper, but let's say it's that. If you want to lower that even more, then you can sell the call against it in the front month. Okay? In the front month,
so
everyone.
Basically, I free up all my capital by doing that.
100%. 100%. You can use that capital somewhere else now, right? And still participate with Disney as Disney goes up. But you locked in your gains with Disney, and your IRA, your Roth IRA is requiring you to hold all of those monies, right? So obviously you have the shares, so you can go.
The only disadvantage is no dividends, right? On this.
So that's correct. That's correct. You're not going to get any dividends off this anymore because you own the options, and the options doesn't have the right to get the dividend. But you can always exercise your right to buy Disney at a certain point if you want to get the dividend and the dividend come out. But it doesn't make sense to do that, in my opinion. This is all about trying to get more of the upside if Disney gives you more of the upside, and minimizing your loss, locking in your gains. So the worst case scenario in the next year. So if you did just this trade, worst case scenario, you lose 1680. And so if you've already, as I say, you had 100 shares already, and you say you bought it at 283. So 172 minus 83, that's $89. So 89 times 100 is $8,900 that you made. And in this case, if you lose everything on this call that you're trying to make more on in the next year, minus 1680, then you still lock in $72.20 or $7,220. So you lock in pretty much all your gain by doing something to this, and now you just got house money, seeing if you can make even more going forward if Disney goes up more.
So it's actually protecting me even if I go down.
Correct. If the market drops, I'm sorry, continue. I'm sorry.
No, that's what you said. Yeah, if it drops down to it'd have to be down to 157 or so, or no. Wait.
So no. It's you don't, if it can drop to zero, and the most you would lose is, I mean, the most you would lose is the 1680. You would lock in your 7,220 if my example is what your situation is, right?
Yeah, and I did buy 100 shares, but
Okay,
I
so
had
there
to
you
put,
go.
and it dropped, and I got forced to buy it, which is fine. I wanted it anyways.
Yes, that's a beautiful scenario. That's an awesome scenario. So now you see what I'm saying, right? If you want to lock in your gains, this is how you do it. And the worst case scenario for you in this example, then, Susan, is that you only make 7,220 off Disney, but most likely, Disney's gonna, they'll just say, I don't know, but if Disney is significantly higher than 175 in the next 345 days, you're gonna make a lot more. But if Disney drops a lot more, if let's say Disney drops back to 100, well, you still locked in your gains at the 7220. So is that clear to you, Susan? And if it's
Oh, this makes obvious sense, and it also makes sense as a protection measure
exactly
for anything that you got a big gain on.
100%, Susan. That's what I'm trying to push here. And none of you heard me say that. If I looked at your account and so forth, and you've been up on a lot, you can just replace it and lock in your gains, and then you don't have to worry about things falling a lot. Sometimes I look at some of your accounts, and some of you have things that are up 2, 3, 400%, right? But you think it's going to go up more, and that's your right to think that, right? And that's and I don't know if I'm right or wrong. In my world, I just like to lock in my profits, and if I'm still super bullish on something, I want to take the risk out. And so, for example, if Ethereum was up over 40 over $4,000, right? If it was a way to lock in those gains without just getting out of it completely, then I would have definitely executed that, because I bought Ethereum at like 1,700, and then it went all the way up over 4,000. Well, to me, if I can lock in my 100% gain, and then if Ethereum drops the way it has, and I only lose maybe 10% of my 100% gain, I'm a happy camper. But if it kept going up and I participated as if I still had all the the same amount in it, then that's just wrong, right? That's glorious. So that's why I love, options, no pun intended, options give you so many options, but you have to understand how to use it strategically so that you can protect yourself, and not just be someone that is acceptable to the ups and downs of something going big, going down a lot if you are usually bullish.
I see the math. I understand the math. But what I don't understand is the logic around how that money is locked in.
Okay,
right?
good question. Let me break it down again. Okay. So let's just
So
say,
I get the math.
yeah. You're gonna get it. You're gonna get the lock in now, but I have to show the math one more time. Okay.
Okay.
So you own 100 shares of Disney. I'm going to use your example, Susan, because it's an excellent example. You bought these shares at $83. Okay? $83 a share, so that equals $8,300. Correct. You bought it at $8,300. Okay? Your 100 shares are now trading at, I just round this up here, everyone, to 173. So now your 100 shares is equal to, instead of 83 here, it's now trading for $173. Okay?
Right.
So you take your 100 times the 173, and that's going to give you, you own 700 and
17,300.
yeah, 17,000, excuse me, $300, right? So you more than doubled this amount here, right? You more than doubled. So now you sell your shares, and in your account, in your cash is going to equal this, right? Your net lick is not going to change. It's already reflecting that, but that's going to be your cash. That's going to be your buying power. It's going to increase by 17,300. You just took off Disney. It's like you took your gains off the blackjack table and you left. Right? They can't win on you anymore. You went back up to your room and you packed your bags and you left the hotel. They
Right.
can't win on you anymore. You've won $17,300 off them when you only use 8,300. Right? So now, if you subtract the 17,000, right, 300 from the 8,300, that's 9,000. That's your gain. Okay, more than 100%. That's your gain. So you want to lock in this gain of 9,000, right? It's locked in now. You went off the table. You went home. Once again, you off the blackjack table. You've locked in this 9,000. But you you want to give some money to your daughter or your son, and you want them to play, right? You want them to play the blackjack, and they're pretty good as well. But you don't want to give them the 9,000, or you don't want to give them an amount that they can lose all that 9,000 again. So what you decide is that you're going to say, I'm gonna let you sit at the table, and I know this is sounding like a ridiculous scenario, but I'm gonna let you sit at the table for a year. Right? You're gonna get to play for a year until you lose all your money, all the money I'm gonna give you. But I have 9,000 that I made, but I'm gonna give you 1,600. I just say 1,700 just to make it easy math, everyone. I'm gonna give you 1,700. All right, I'm gonna give you 1,700. So now you take your 9,000 that you take off the table already, right? And you subtract your 1,700 from it. Okay. And now that you subtract your 1,700, you have 7,300 that you locked in. There's no way you can lose. There's no way you're not going to win at least 7,300, even if your son or daughter loses all the 1,700 that you gave them to play blackjack for the next year. You locked in this game here. There's no way you can lose. You already made 9,000. You took 1,700 of it. You took this 1,700 to play some more. But even if you lose all this 1,700, you still get to keep this 7,300. There's no way you can lose this 7,300 used on Disney. You've locked in that game.
Right. Okay, I get that. Now the question becomes, I can still win
Exactly. I'm saying
on
in this scenario, exactly.
okay.
You can still win, but we don't know how much that's going to be. But you can still win because you have this call here. But let's just say you didn't win. You lost everything. You lost the whole 1,700. Well, if you did, that's fine. You still locked in 7,300. This is gravy here. You already locked in a huge game.
Okay. Okay.
You already locked in a huge game. This is all gravy. If it goes up more within the next 345 days, then that's great. You have the potential to make more than the 9,000, right? That you originally
Okay.
made, and you took that 1,700 to try to make more.